Hi everybody, I'm new to YouTube channel and I am super excited to finally meet you all here. I will be sharing some of my financial thoughts on this channel. Today, let's talk about something fun, how to spot 10 bagger stocks in the Malaysia stock market. A 10 bagger is basically a stock that grows 10 times from the price you bought it. In other words, the company's market cap becomes 10 times larger. Now, let's be real, the chance of finding one is low. But if you do, it is life-changing. For example, if you invested RM10k, it could grow into RM100k. Not bad, right? That is like turning your Magnum and Toto money into something way more useful. And don't worry, I'm not a professional investor or fund manager. I will explain in layman's terms, so every retail investor can catch the idea. If you are serious about investing, you must familiar with the size of companies in terms of market cap. This helps you to compare small cap and big cap companies. And trust me, once you get familiar, you will get a feel for what is possible. This group of listed companies has a market cap above 10 billion. Take a moment to observe them. From this group of companies, you will notice that companies reaching beyond 10 billion are typically those that either monopolize their industries or have successfully expanded globally with a business model that is difficult to replicate. Therefore, we can exclude such companies from our list. This includes those in banking, utilities, transportation, Petronas Group, telecommunications, healthcare, and entertainment. For industries such as palm oil, property, multi-sector, and conglomerate, they had the first-mover advantage, cheap land, low competition, not something we can replicate today. That leaves us with manufacturing, construction and consumer sector. For example, P Metal globally integrated aluminium producer, Gamuda and IJM in mega construction project locally and globally and well-known consumer brands in Malaysia. Okay, let's move to the stocks with a market cap of 3 to 10 billion. Again, remove the industries that are tough to replicate, banking, telecommunication, insurance, oil and gas, multi-sector conglomerate, aviation and palm oil. Remember the remaining companies and industries, as they serve as example of business models capable of growing to a market capitalization of RM10 billion. This is important because the first key factor in identifying a potential 10 bagger stock is starting with a small company, typically with a market cap of only few hundred million. From this group of companies, the industries with stronger potential to produce 10 bagger stocks include tech, semicon, EMS, consumer, manufacturing, property, and construction. To put it simply, for a company to build an empire worth more than RM10 billion in market capitalization, it must either operate as a multinational business or become a retail giant in Malaysia or abroad. On the other hand, companies with the potential to grow to the 3 to 10 billion market capitalization range are typically found in sectors such as tech, semicon, EMS, manufacturing, property, and construction. Okay. Now you should have a clearer sense of which sectors deserve more attention when searching for potential 10 bagger stocks. Let's look at a few examples. At its IPO in 2000, QL Resources had a market capitalization of around RM150 million and operated mainly in marine product manufacturing and integrated livestock farming. Over time, it expanded into palm oil, environmental technology, consumer food, and most notably, the popular Family Mart convenience store chain. A strong company continues to expand and diversify its business, allowing earnings to grow instead of stagnating. QL also pursued international markets instead of relying solely on Malaysia. As a result, its market capitalization grew from RM150 million in 2000 to RM15.9 billion by July 2025, an impressive growth that is very difficult to replicate in today's market. The next is Vitrox. Vitrox, a semiconductor-related company, had a market capitalization of just RM50 million during its IPO in 2005. It focused on automated vision inspection systems and equipment for semiconductors, printed circuit board assemblies, and electronic communication industries. By successfully exporting its products overseas and consistently growing profits, Vitrox's market capitalization expanded from RM50 million in 2005 to RM7.5 billion today. Let's look at Padini. Initially, Padini operated multiple brands through individual stores. To improve efficiency, management introduced the Padini concept store, consolidating all brands under one roof. They also launched Brands Outlet, offering affordable apparel for mass-market consumers. These strategic moves drove continuous sales growth, lifting Padini's market capitalization from RM250 million in 2006 to RM1.9 billion in 2025. From all these examples, we can actually find some common rules that 10-bagger companies tend to follow. First rule: start small. The company's size must be small at the beginning, preferably around RM100 million to RM300 million in market capitalization. From the group of companies I mentioned earlier, it is possible to grow from this small base to RM103 billion, and this kind of growth is replicable. You usually find these opportunities either in newly listed companies through IPOs or in existing listed companies that have been acquired by strong entrepreneurs. Second rule: very high growth. The company's profits must keep growing year after year. There are four main pillars that drive this high growth. 1. A strong business model that allows the company to capture good market share through its products or services. 2. Pricing power, meaning the company can provide quality products or services with strong profit margins. 3. Scalability, where the product or service can expand both locally and globally. 4. A capable management team that runs the business efficiently in terms of cost and quality. As retail investors, we don't always get to meet or talk to the management team, so this factor is not so meaningful to the retail investors. So as retail investors, monitoring the hard numbers is meaningful, such as net profit margin, positive operating cash flow, high return on equity, and a healthy balance sheet. Looking back at our examples, QL net profit grew from 17 million in 2003 to 550 million in 2025, Vitrox grew from 9 million in 2005 to 201 million in 2022, and Padini expanded from 7 million in 2004 to 222 million in 2023. The third rule: high return on equity. ROE is important because it measures both the efficiency of the business model and how well the management team utilizes shareholder funds. Let's take a simple example. If you and your partner put in RM100k as capital to run a business, and the business generates RM20k in profit, that's a 20% return on equity. Very good. But when a business grows very large and has limited room to expand, management might park excess earnings into fixed deposits or investment funds. If the FD rate is only 3%, then the ROE drops, because shareholder funds are only generating a 3% return. That's why for a growing company, you want to see an ROE of at least 15% or higher. Before we wrap up, here's an important reminder for all retail investors: never fall in love with any stock, even if it has delivered strong profits in the past. Just like running a business, retail investors don't have the same competitive advantages as institutional investors or fund managers. That's why we must always invest based on facts: quarterly reports, annual reports, chairman's statements, business prospects, and share price trends. If a company's performance deviates from what we expected, we must be disciplined enough to cut our losses, even if we've held the stock for many years. Remember, our goal is not to prove we are right. This is especially true when investing in small-cap companies. Another common mistake is blindly believing in buy and hold without monitoring performance. Many investors only realize something is wrong after the share price has already dropped significantly. Please, Always keep track of the companies you invest in. If you're not willing to monitor them closely, then it's better to stick with blue-chip stocks or funds instead of small caps. To track performance effectively, attend the company's AGM, listen to their plans, and even try their products or services yourself. And always remember, never make excuses to convince yourself to wait for the next quarter if the results are already disappointing. There are plenty of choices in the market, you can always look for the next opportunity. To summarize, here are the 3 golden rules to find a potential 10-bagger stock. 1. Small size, ideally RM100, 300 million market cap at the start. 2. High growth, consistent profit growth with strong margins compared to peers. 3. High ROE, at least 15% and above to show efficient use of shareholder funds. Look for newly listed companies from IPOs within the last 5 years, or small listed companies acquired by strong entrepreneurs, like how Kejoya Prospect acquired Vitrox. Add these names to your watch list, monitor them closely, and you might just find the next winner. Thank you for watching my YouTube channel. I hope you enjoyed this content. I'll continue making videos to share my thoughts in simple, easy to understand language so all retail investors can benefit. If you found this helpful, please like and subscribe to my channel. And just a quick disclaimer, everything I share is purely my personal view. This is not a buy call or sell call. Let's enjoy investing together, and observe how the world transforms from the mobile internet era into the age of AI and robotics. Let's ride the wave together.